Hey guys, this is Julie. Thanks for coming back. I'm going to take a quick look at the expiry for the quarterly coming up and our contracts coming up this week. The options expire for the quarterly um, options as well as the futures it roll the contract also for the quarterly. So we're in the middle of the ones, as you can see. I have a double distribution. I use a 3-month historical as well as a 12-week. And so this provides me the overall framework for that period and of historical volatility. And right now we're right in the middle of this range. And the volatility compared to last month is much lower. It's been coming down. We did have the highest volatility peak of the week on the 7th, and that was an up bar. So the highest volatility peak for the week was an up bar. Okay. And so we would assume that this will be trying to reach um, the middle so that we can be in the middle of the range when we get into that CPI, PPI, OPEX, and then expiration. It could be a very volatile week, but so we're expecting price to come in and tag the one almost. We'll see if we get an immediate rejection if some news event were to come out. Um, and how would we like to trade this? The thought being, of course, I keep saying this like a broken record, if we're in a bear market, they're going to be hitting those ones. And this is the 12-week one. So we've already had a response to it once. So it has already been a resistance line. So we'll see if that resistance holds or if they do a little stop run. The outside risk would be 14,398, 14,400. And we'll see if if we get into a situation where we get a beat for that seasonality in August on the CPI and it rallies up and breaks it. They're just going to be, buying calls and making as much money as they can for that short burst. So I would go with it. You never know what's going to happen with the August report, so be prepared. To go anyway. So it would be difficult putting a spread together, but just for grins, we can put, a spread together, keeping in the theme of these ones are being hit all the way down, as we can see from the past experiences. We did break it, though, once. We did break it, and it failed and came back in. So I don't know if that was a stop run back in and then resistance, or whether that is just a precursor that the market could continue moving higher. So to answer these questions, now that we know that we're trying to get up there and at least hit the line, is look at your CME pricing sheet at the quick strike. So I've got my expiry set in for the September 16th contract quarterly, and I'm using the Black-Scholes volatility to price on the settlement. And so when you scroll down, you can find your normal strangle levels, to 15 delta put, and you can get a 10, um, you know, 5, 10, wherever the line is. It looks like that would be, a 10 right here at 13,130. And go back. So the 15 would go from 1290. Here's your 1-2 up here. 12,140. So I would say 12,100. And we want to look and see where your um, delta gamma is. We're expecting volatility, it's low, but may be moving up just a tad. Um, so we're currently trading at 12,590 at a 26.43 vol. So right here, 12,590. Price came right back to the mean on the quarterly for Friday. So it is already at the quarterly mean. I'm going to put that on the chart real quick. I always make the separate your colors for your mean from the other support resistance. All right, so we're at the mean and looking at the delta gamma, gamma delta, and your other ATM ITM pain points. Um, High gamma would be the 90s, so 12,670 to 12,610. So I'm going to put the region highlighter. Okay, there's my high gamma, so we're sort of sitting on high gamma, just under it. So that's a big help. So that's your pivot. And we can put the lines on the chart, 12,100, 13,130 for the implied volatility. All right, so here is the anticipated range for the deltas, the way that the option traders are looking at this for their strangle. And we can use the real volatility level and maybe be able to save some premium, get in a little bit tighter on a very volatile spread. But we know that if that breaks those ranges, we're definitely going to be looking for these higher strikes and lower strikes to trade to. And go back and look at some more of the Greeks. We've got a flip at 840, 830. And that is right on my 2. So that could be a key support resistance area. And then 340, 12, 340, 12, 330. All right. So you can see that there is going to be a supply zone sitting in here, would be my guess, if this is going to go long. Um, so watch for that pivot, and we can try to build a spread around that and maybe use this upper level as the boundary line. Anything above this, we're definitely, the risk would be to the three, if not breaking it and going higher, depending upon, the magnitude of the change in CPI, because we are very, very oversold. So let's put a spread together and calculate some of this premium. So I will come over here to the spread builder, choose my expiry. I'm already on the NASDAQ, and build an option, put call, and I want to put my put at 10,750. That's kind of low. But yeah, 10,750. And then I'm going to invert that. That's a short put. And for the call, that would be at 13,837. So we need to come over. There it is. I was looking for that. 13,850. Okay. So there is the spread going into next week. 10,750 put, 13,850 call, selling both. And so I want to save this spread. And then we can analyze it. So that would be about $1,000 that we could collect in premium. 1.09, so 1,100, something like that. 090. We can, see how that works out for us next week. There would be the football field, and here is the, simple strategy. Um, and can look at our detail again. $9 premium. So we're looking at a 26.54 volatility. So we'll go back to the pricing sheet and just take a look at that. Again, make sure I have my Black Scholes on the settle. Yep. 26.54. And let's just go down and look at it. Right here. 12.580. Yep. That's right where we are. We're right over it. We're right on it. So there's our benchmark, and there's our, strategy for um, next week, and see what happens with the volatility. And did I put 10,750? Right here. So we're giving it plenty of room inside the ones to play around in, and may take a little heat up to the 3. So, to hedge that, you can just come in here and sell another put, or sell another call, excuse me, at 14,400. So in fact, if we just do another single trade, spread builder, and I want to do a new one for next week, and we're just going to sell 14,400. Right here, and I want to short a call. Okay, there's my curve, and save that. Go into the Analyze tab, and you can see that we'd get 5 cents for that trade. But every little bit counts, right? You get a lot more selling puts than you do calls. But that may offset, your the difference between going from 13,850 to 14,4. So that would cover your break even, hedging it. Okay. So there is our world for next week. Let's see what happens. Anything above that, um, third standard deviation, say you got the fantastic news that um, the seasonality came back and there was, psych, there's no inflation, and, and the market just starts taking off, you would be buying calls up here. And the puts, selling the call and selling your put, probably you would close it. Well, you may leave your put open, it would expire worthless, which would be paid. You'd keep that premium, but you would close your call and start buying them. And you would be hedged all the way through 14,400. Okay, so that's the plan for the NQ. Let's look at the ES. And since we already know the playbook, we're just going to do the same thing. Maybe not. No, I think we will. All right. So here is the similar levels. We're a little bit lower, um, but very, very similar makeup on the volatility. You can see it looks exactly the same. We had the high volatility spike on the 8th, the day after the 7th. So NASDAQ broke out. This was a high volatility on the 7th, but the 8th also. So you had 2 days in a row of high vol, and it pushed it over the quarterly one on high vol. High vol spike going long. So high vol long going into the mean, which were not the mean, but going back into the one up here. And that is the weekly 12 PT1. So anything above that PT1, you would just want to be buying calls or trading to the 3 for sure. Yep. So let's look at the pricing sheet real quick. So we can open a new tab, go back to Quick Strike. Oops. Click a new spread, change the contract to the E-mini, and now choose the quarterly. Start our option spread, and we want to 3604, 93, 3603, 3600. Okay, and then we want to add 4463.50. Well, we could do the two things. We could put the spread on. Well, we'll just go on, yeah, to 44.50. All right, and we're going to do the invert the long strangle to a short strangle. All right, so here's our perfect strategy, the way we want it, set it up. And go into the Analyze tab. And there we can see that we would be getting about $220 for the spread, right? 0.22. Not much, but there's not many days left. But you add that together with the NASDAQ, and then you can do this, see what I'm saying? You can do it with other instruments as well. So that would be a good way to start the week. And see what happens. Like I said, if the spread gets challenged, close it and buy calls. And that would be on the event of our breakout um, trade. So we want to look, I want to show you one thing in the NASDAQ real quick before we go. And that would be to see the Globex daily weekly setup. I've got a template for us on Wednesday for our training. And basically, we can see that the market trades from the bottom of the daily Globex range to the top, from the bottom to the top, and stays inside this distribution most of the time. Um, very much most of the time, it stays inside. So those levels can be used for everyday uh, strangles. So I'm going to be start calling myself the Strangle Queen pretty soon because I have this. Look at this. I mean, I don't know if you understand what you're seeing, but if you get it, then you realize that we have identified a distribution that we can rely on that is pretty rock solid, steady as far as, staying inside of it. When it does break out, all we have to do is take advantage of that and go short at that moment. And I'll show you what that looks like. You've got volatility peaking, and you can, set a standard, line in the sand. And when that line in the sand breaks and you're below your third standard deviation of the daily, um, or the Globex, whichever is lower, then you get the signal to break out. And that way you have a hedge. But otherwise, you're selling premium and, um, yeah, trading inside the distribution. So I've got this template set up for us, already coded up and ready to go, and we'll talk about it, as well as some other methods of, if we want to trade directionally intraday, trading with volatility only. So, and relative to where price is to breaking the ones. So when we do break the ones, we do want to go with it and start, purchasing in that direction. So my template trades the volatility breaks and of real volatility. This isn't implied volatility. I'm not doing deltas or anything like that. This is just real volatility levels. And so when we put the implied volatility levels with this, hopefully we can really fine tune some entries and start taking a real sharp focus at this. So we know that we're sitting at resistance, and we're going into resistance on a higher time frame. So we break this high gamma Sunday tonight, then we know where to look for the bumpers, the first targets. And we just need to determine whether, those reports are going to be yay or nay. And if they're good, we'll be above the pivot, right? Already, because we're going to be up here testing the ones. And it can literally jump the shark fast and start flying. Be prepared for that. Close the spreads and just buy calls or sell future. I mean, buy futures. If it fails below this pivot, the high gamma, we want to be below that one right here and then trading to our lower targets. And the bottom target would be 95.10 for the NQ if it did turn around. So say the inflation came in at 500% higher than the previous month. That's not going to happen, but no, that won't happen. But trade, use the probabilities of, these distributions and trade within the ranges. Just, stay within, the green 3 and the green 3, bottom and top, and, realize what it looks like when these anomalies happen. It does fall apart. Um, Very rarely does it fall apart, but it does occasionally, and that's on those big event news things. This was COVID, and this was the reaction to COVID to get it back up to even. That nice little pop back above. But otherwise, it stays in the distribution. This was the last time Powell attempted QT, right? Keep going back to that, reminding myself what can happen literally next week, over the next 2 weeks. He is tightening and raising. So be prepared for that downside price action too. And there was another, yeah, this 2016, that was the crude. When crude hit, minus, 30 or whatever it was, and it just started selling off. That made the stock market crash the stock market too. So, these markets, it doesn't just have to be, the equity indexes. Crude can do this. So, something happens, we have zero SPR. Something happens with a hurricane, wipe out some platforms. That can affect the price dramatically. So, just know where you are in the football field. Know whether you are inside the distribution or in an extreme tail event with really high vol. Set yourself an uncle point if you don't want to trade above a certain volatility level. Make sure you're aware that you're flying in the clouds, and you may want to sit out and wait for lower volatility opportunities, and pick your locations. Make sure you're aware of where these threes are on these higher time frames, because that is precise. That's pretty much where the market likes to go, right down to it, and then turn around. So know where these levels are, and come and get the indicator. It's available on the website, jautotradingstrategies.com. Swing by, pick up the PT indicator, and you can own it. Or stop by the Twitter if you don't have NinjaTrader and get a monthly subscription, and you can see some charts and levels posted daily. All right. Thanks a lot, guys. We'll be ready for our week next week, and gird your loins. See you soon. Thanks.